For most business owners, selling their business is the biggest financial transaction of their life. And there are a few simple things that can be the difference between a nice, smooth, successful transaction and one that ultimately ends in failure. Today, I'm going to be talking about what those few things are, with a highlight on cleaning up your accounting records. I'm a CPA, and from my experience working with small business owners, this is one of the biggest hiccups in any transaction they do, is nailing down their accounting records, really owning it, and knowing the ins and outs, how the economics of their business equate to a transaction price and how you can get the most bang for your buck. So I have a few slides that I have planned to walk you through to help guide you through this. And I have some other examples that I'm going to show you as we go along here. I have an example chart of accounts for cleaning up your accounting records that I'm going to show you as we go through here. And then we're going to finish with some tips for what a potential buyer might expect from you as the business owner, simply in terms of how well do you know your business? Where is it going? Because ultimately any buyer is going to want to know what's the direction of the business. How do you feel about it? So let's jump right in there. So we're starting with how to clean up your accounting system. I'm going to talk through these focus areas. These are balance sheet and income statement, financial statement line items. These are the main ones. Obviously, there are others, but these are the ones that you need to focus on to, quote, clean up your accounting records. So this is what people are talking about when they say that. So I'm going to talk you through how this works. But ultimately, what everyone means, or any financial professional says, how clean are your books? How clean are your records? This is what they mean. They're organized in a systematic manner. You don't just have records haphazard, like strewn across some random room in your house. You have a system. You have a filing system, either digital or physical, for your supporting documents, and they're organized in a way that can be easily where you can easily identify certain paperwork. So if someone asks for an invoice to support a transaction that you've recorded, you have a way to easily get at that, and you're not hunting in this, massive pile of papers. So that's, I just hit on the first two here. So organized in a systematic manner, easily accessible. In other words, not time consuming to retrieve and package. So if you have a request from a bank or a potential investor or some other third party who needs to see your books and records, every year you likely provide your records to a tax accountant, so this includes them. You should be able to export your accounting information, so it's simple balance sheet and income statement, within minutes. And you shouldn't have to explain every little thing. It should be clear enough, I should say, that anyone who is familiar with your business should be able to figure out what's going on. You'll see how you've done in a quick snapshot. So that means having a thoughtful chart of accounts that's comparable to other similar companies. So if someone has experience in your industry, they should be able to pick up your chart of accounts and say, oh yeah, this looks right. This makes sense to me. So not just having, like I said, haphazard accounts where, they're titled strange things and, there's no roll-ups, which we'll get into. I'll explain what that means. So it's incredibly difficult to summarize your account balances and things like that. So it just makes it messy. That's what we're trying to avoid. So when I say thoughtful chart of accounts, that's what I mean. You've actually thought about, how do I want to structure my accounting records so that I get the best reporting? And I know it sounds boring and it sounds like, this is just something my bookkeeper should do, but this is one of those situations where you want to start at the end. You want to start, okay, what kind of reports am I going to need? What is a potential investor, a bank, or my tax accountant going to need? How do I back into that? So how do I How do I build an accounting system from the beginning to make it easy for me to produce that information? Okay. So the next one, consistency. Be consistent. You need to record transactions every single month. Don't let them pile up. If your bookkeeper is not doing a good job, tell them so. Tell them they need to be consistent. Get transactions recorded timely, and they should be recorded in the same manner every single month. So there shouldn't be, a new approach to booking a journal entry or recording an invoice. It should be very consistent and simple. That makes it easy to identify issues later on. If there's a mistake or something that looks odd, consistency in your accounting records makes it very easy to figure out what went wrong. And the last one here, I put it in all caps, complete and accurate. And if this was your only goal, that would be enough. So at a bare minimum, you should have recorded all of your transactions. That's what completeness means. And they should be in the right period. So we're not moving revenue into the years that we want them to be in, and we're not moving expenses into, months or periods we want them to be. We put them in the period in which they were incurred, or for revenue, the period in which they were actually earned when you did the work or delivered the product. That is critical. And obviously accuracy, recording them at the right amount. All right, how do you achieve this? So you put some thought, I'm not talking about breaking this down and, having it be like rocket science. It's not, it's basic stuff. Just put some thought into your system and do the same thing every month. So figure out what works best for you. What works really well for some businesses, maybe more than what you need or not enough. So other companies may have a really complex filing system, but you might not pay that many bills every month, so you don't need this, crazy filing system to be able to retrieve invoices and find them easily. You might just use a simple filing system. Organize your invoices by vendor and by month. This makes it very easy when you're looking at something that doesn't look right, or if your books are getting audited as part of the due diligence process, and an auditor asks for something, and they're using like a account transaction history to identify certain things that they might want to test. If you organize by vendor and month, you can just simply look at the transaction and say, oh, it's in December and it's this vendor, so I know exactly where to go to retrieve that. This is really important, because if your tax accountant, not just your auditors, but if your tax accountant needs something to figure out if a particular expense is deductible, for example, you want to be able to quickly and easily pull this information so you're not wasting your own time. So these are simple things that you can do as you go every month to make this much easier on yourself. Organize customer invoices and contracts by customer. I know it seems obvious, but don't just have paperwork, strewn all over the place. Put all the documentation for each customer in its own folder, digital or hard copy, so that it's all there if anyone asks for it. This would not be uncommon. This would not be an uncommon request as part of due diligence to look at customer contracts. So if someone asks for that and you're like, oh, I don't know if I have that, or I lost it, that's not going to look great. So the due diligence process isn't just, the science of computing the value of your business based on your cash flows. A potential buyer is also evaluating how easy it's going to be for them to pick up your books and records and be successful. So having an organized system in place already makes their life so much easier, and ultimately will increase your chances of having a successful transaction. Okay? Maintain notes for odd items that might require explanation. This should be simple and basic. Don't go crazy. But if something is unusual for a particular month, an odd transaction that doesn't occur very often, write it down. And I'm just talking about, writing a few notes in a Word document and saving it someplace where you can find it, in a folder for that month or something like that. So if someone asks, you're not having to refresh your memory or, track stuff down. You already have it written down. Large companies will write memos for a ton of transactions. Anything unusual or complex gets a memo. I'm not saying that you need to do that as a small business owner, but keeping just basic notes goes a long way. Periodically review your chart of accounts. And the ultimate goal is to put it in the simplest form. You don't want to engineer this insane, origami puzzle of chart of accounts, and I'm going to get into how this works, but what you ultimately want is a simple chart of accounts that can easily be summarized to convert it into a set of financial statements. So in other words, you have a line in your chart of accounts that's cash, and you don't have to make any adjustments to that. You just put it in the cash line in your financial statement. Same thing for accounts receivable, inventory, property and equipment, accounts payable, etc. So we're going to get into what a simple chart of accounts would look like and go from there. All right. Do the same thing every month. I said this earlier, but it bears repeating. Don't vary. Don't miss a month. Record every transaction in the correct period. I mentioned this earlier. And if possible, make sure a second person reviews the input of a transaction every month. So if you have one bookkeeper doing all this work, guess what? People make mistakes. They fat finger numbers when they're putting it in there. They might swap the last two digits of a number that they're putting in there, if they're typing fast. And this stuff will show up sometimes in a reconciliation if you're doing month-end account reconciliations. But it is a lot harder to find an error later than it is to prevent it. So as a rule of thumb, always have a secondary check of someone's manual work, to make sure that they didn't make a mistake. So if you have a bookkeeper, I would recommend picking up the work they've done for the week or the month, depending on how much volume you have, and just spot checking. If you want to check everything, go for it, but spot checking is fine too. Definitely review their account reconciliations and make sure that, those look okay. This doesn't take that long, so if you have a system in place and you do this every single month, it gets faster and faster and faster. So I'm not talking about adding, hours and hours of work to your plate. Ultimately, doing these few things will end up saving you a lot more time in the long run. Okay, practical application. I'm going to run through a whole bunch of stuff, but I want to show you a chart of accounts first. Just a simple chart of accounts. And before I do, don't use two accounts when one will do, and begin with the end in mind. So think about where you ultimately want to get to. What types of reports do you want to be able to produce, and then work from there. So I put together a simple chart of accounts here. This is just to demonstrate what a simple, basic chart of accounts would look like, in how you might be making this a lot more difficult on yourself than is necessary. So I'm going to run through all of these in the slides, but I just want to point out these are your individual accounts. So, these ones here, all the way through, the ones that have the left are indented to the left. And these are your, what I like to call roll-ups. So all the account balances, here, for example, raw materials, WIP inventory, finished goods, all would sum up to total inventory. So if you went to build a set of financial statements off of this, all you would have to do is say, okay, cash, total cash, boom, that goes on your balance sheet. Accounts receivable, boom. Inventory, all the way down. Prepaid expenses, property and equipment, accounts payable, accrued expenses, other liabilities, owner's equity and all that. And then same thing for revenue. You might have two accounts, one for, two different product types, and then, revenue streams as well, So, but see how simple it is. There aren't a billion roll-ups in here. It's just a bunch of accounts, roll up, a bunch of accounts, roll up. So simple, just subtotals getting you there. If you wanted to build a report off of this, it would be very easy. So like if these are all the accounts you had and you just wanted to compare month over month, this would be very, very simple to see. Oh, like, hey, this jumped over this month and I didn't expect that. Like marketing, for instance, like this increased way more than I was expecting it to. That doesn't make sense. That makes it a lot easier for you to dig in. Sometimes you might have a particular revenue stream or product, like a product or a service that has its own certain expenses associated with it that aren't directly attributable to that. If you have, for instance, if you have one business that does one thing, and then you have another component of the business or division of the business that has its own employees, its own revenue, pays the bills, but ultimately the two components or three components or whatever it is together comprise your entire business. It might make sense to break out these accounts, to have more accounts, more roll-ups by component of your business. But you always want to come back to this. So you want to, what that would look like is you'd start with this, this simple chart of accounts, and you would just duplicate it. So you would have, more accounts like this, but you would give them like a hyphen, so you'd call it like, you'd put, like something like that, like a hyphen 0001, and that enables your accounting software to produce a report just for that one component, so you could just compare at that level. Okay, so that's what I wanted to run through with that example. I'm going to dig into each one of these now. This is how you clean up your accounting records. This is what you do to build your system to give yourself the best chance of success in a sale transaction, okay? So chart of accounts, like I just showed you, use a separate account for each bank you use, including petty cash. It makes it way easier to reconcile each account to its respective bank statement. Reconcile all of those accounts, every single thing, including petty cash, monthly. So the bank accounts, obviously, you're going to reconcile it to your bank statement. For petty cash, you're just going to count the cash that's in your petty cash drawer or whatever however you use that. And if you have a bookkeeper do this, definitely review this reconciliation. I know everyone's terrified of fraud happening in their business, and most people who fraud happens to, they're like, oh, I never would have thought that person would have done that. I trusted them all this whole time. So it's always the person you trust the most who steals from you. I hate to say it, but make sure you're reviewing reconciliations, definitely cash reconciliations, to make sure that the checks that were written out of the account are familiar to you in the correct amount, to the right payee. Make sure the reconciling items, the differences between your accounting records and the bank statement balance make sense to you. For instance, you may have made a deposit, but maybe you didn't bring the deposit to the bank yet. You did it in your accounting records and it's ready to go. You just have to deliver the deposit slip in cash or check or whatever to the bank, and so that's a difference. So make sure that stuff makes sense to you. Keep track of reconciling items that have been outstanding for longer than 2 months and follow up with vendors. So if you have a vendor who doesn't cash checks in a timely manner, give them a call. I know it seems silly because it's like, well, wouldn't I want that cash in my account for longer? Yeah, I guess so. It increases your cash balance, but you know they're going to cash that check eventually. You just don't know when. It's easier for you to track your balances and how much cash you have available if they're cashing their checks timely. It's just annoying when you write someone a check and it takes like a year for them to cash it. So I recommend following up. If you have a ton of these outstanding cash items when you're going into due diligence, huge red flag, because at a bare minimum, you should be controlling your cash. You should be focused on what you're doing with your cash. And so that's a big red flag for a potential buyer if you're not, doing these simple things. Accounts receivable. Use one account for the most part. I don't. There's very rare situations where you need multiple general ledger accounts on your chart of accounts for accounts receivable. Just use one. You can always run what's called an accounts receivable aging report that will show what's due to you by customer. And so, if you have multiple components of your business, like we talked about earlier, go for it. Have more than one account. Have an accounts receivable account for each of your components. But there is really no reason to do more than that. You can get all the information you need from an accounts receivable aging report. Make sure you're reconciling this account balance for accounts receivable to the AR aging report. The only reason there would be a difference is if someone either mistakenly or on purpose manually made a change within your accounting records to accounts receivable. So normally an accounts receivable gets recorded automatically by your accounting records when you invoice a customer. So you have to bill them, so you put an invoice in there, and it either records an entry to revenue or unearned revenue. If you're billing for more, if you're billing in advance for some service or something, or if they paid you in advance, you billed them in advance for a product or something that hasn't been delivered yet. You'd still have an accounts receivable. They still owe you per whatever your agreement was with them, but you haven't earned that yet, so it's deferred revenue. But I digress. Make sure you're reconciling your accounts receivable to your aging, and that there aren't any manual entries like that. If someone, God forbid, was perpetrating a fraud, one way to do that is to pay themselves in cash and then book a manual entry to accounts receivable. And that way the receivable, to themselves won't show up on an AR aging report. So very critical. If you frequently have customers that don't pay, you should estimate how much, so something called a bad debt reserve. And that is how much you expect to not be paid. And generally what most businesses will do is they'll say, okay, on average, 10% of receivables that go past 60 days due are not going to be paid. So they'll just take an AR aging report and say, okay, everything over 60 days, I'm going to multiply that by 10%. And, that's my bad debt reserve. It's as simple as that. For due diligence, it's always better to be honest, because anyone can come in and figure these numbers out. They're going to know how much you've lost, but if you're doing a good job at estimating it and tracking it, and you're on top of it and can explain, variations and how customer non-payment and things like that, and what you do to avoid it, that makes you look like a pro. And likewise, have a process for following up for customers who are late. Be good at collections. It's critical that you collect as quickly as possible. That enables you to have a higher cash balance. Inventory. use one account for each stage the inventory is in. So if you're doing manufacturing and you have raw materials, work in process, and finished goods, as opposed to a company that has an outside company produce your product, in which case you'd only have finished goods, then use one account for each type. That's going to make it easier for you to figure out how much inventory you actually have physically in comparison to what's recorded. So the next bullet here, physically count your inventory. This is going to give you something to compare back to. So you're going to literally twice a year count all of your physical inventory and compare it back to your accounting records to make sure the counts line up. If you discover damaged inventory, or you realize that inventory is no longer saleable because it's obsolete, or it's just no one's buying it, if you cannot get what's called a salvage value, if it has no salvage value, so you can't just liquidate it to somebody and it's worth nothing, write it off. It's a loss. Get rid of it. Don't keep this stuff on your books. Any person coming in doing due diligence is going to identify this stuff. They're going to have an auditor count your inventory themselves, and it's better to just get out in front of it and know what you're looking at here. Okay. Property and equipment. Use one account for each type of property and equipment. So if you have land, have an account for land. If you have a building, have a property, an account for your buildings. Same thing for equipment. Have a written policy for how many years you depreciate each type of property or equipment and stick to it. No exceptions. So if you depreciate your cars over 5 years or 7 years or whatever, always do it the same way. If you depreciate buildings over 30 or 40 years, always do it the same way. Have it written down so someone knows. That way, any buyer coming in wanting to take off your depreciation expense, or just wanting to know what your policies are and how that has factored into your earnings over the years, your net profit, they'll have an easy way to get at that and just know exactly what your accounting policy is. Maintain a list of each property and piece of equipment that includes all of these things. The type, the address, where it's located, original cost, accumulated depreciation, so how much depreciation you've taken life to date, and the original depreciation term, otherwise known as the useful life. How long this thing is going to be useful to you. Most accounting software does this already. So when you buy something, you can actually input all this information into your accounting system and then just produce a report that lists all this stuff out. But this is going to make your life so much easier in due diligence, because if someone's buying your assets with the business, you can just easily run this and be like, here it is, and then they can take that and, hire, most likely what they would do is hire an actuary or, a real estate valuation specialist or, something like that. There's a valuation specialist in my experience for literally everything. It's nuts. I had someone once value an oil well for me. And what else? I had someone value like a mine car. I didn't even know these people existed until I actually needed to find them. But so someone buying your assets, doesn't matter what they are, they're going to find someone who knows what it's worth. And so having a list of where all this stuff is and what you have it recorded at is huge. Again, similar to inventory, if something is damaged and is obsolete, I guess best not being used is probably a better word for it here, and the actual value is less than what you have it recorded at, write it down. Don't wait. It's called taking an impairment charge. So that would just be an expense on your income statement below the line, under. It doesn't go like through cost of goods sold or anything like that. It just gets its own expense line for, loss, write down, wherever you want to call it. There's no need to hide it. This stuff, Don't feel like it makes you look bad. Actually, it makes you look good because it makes you look like you know what you're doing when you do stuff like this. When you get out in front of it and are in control. Accounts payable. Use one account. Same thing as accounts receivable. You can run an aging report that has all the vendors that you owe. And just like accounts receivable, make sure your balance in the account in your accounting records agrees to the total on the AP aging. Okay? Same thing, someone could record, a dummy entry in your accounting records instead of entering a bill. That's how it gets on the the AP aging report. You enter a bill to a vendor, and then QuickBooks or whatever system you're using has logic built in that automatically makes sure that that bill will show up on your AP aging report. So if someone doesn't enter a bill and they instead enter what's called a manual journal entry, they could just hit that. And then, there's a few entries someone could do if they're trying to perpetrate fraud to hide it from you. So this is just simple stuff to catch this stuff. I keep bringing up fraud because if God forbid there is fraud in your business, you don't want to find it when you're going through due diligence. You want to find it it's always better if you find it. And don't think that like an auditor is going to find it, they're going to do an audit, so they'll figure it out. Most frauds are not caught by auditors. Most of them are caught by someone within the business. Okay? So just be focused on this. Know how to detect this stuff. And even if it's not fraud and there was just a mistake, like your bookkeeper was recording a legitimate journal entry and they booked it to the wrong account. That's another reason why it wouldn't agree. So there could be an honest reason for that. If you're late paying bills, be ready to explain why. So if you have a bunch of unpaid bills, someone's probably going to ask you what's going on. Like, do you just not have a good process? Are you not focused on this? A buyer might be concerned about that. So because if you're late paying bills, your vendors, the list of people you buy from, obviously your buyer is going to want to, probably keep a relationship with most of these people, especially if they're producing your products, or if you have outside contractors helping you deliver your service. They're going to want to maintain good relationships. So if you're not on good terms with them because you're late paying, it's not going to look great. So make sure you're on top of this. Accrued expenses. You generally only need one account, but multiple is fine if that's just how you want to see it. So if you have usually lawyers are the biggest, reason for needing an accrued expense. They're not great at billing, so you might use a lawyer for something and they performed a service for you, so you've incurred an expense, but they don't give you a bill in time for your month-end close process. So you have to guess or use, whatever they told you as an estimate for their services or something like that to guess what the expense was. And then you accrue for that, so that you make sure you get it in the month. So you used $1,000 of legal services, so you have an accrued expense for legal services. And then when you get a bill, you replace the accrued, amount with the bill. But you could have a bunch of different stuff here. You could have, this could be like a tax, like a current tax payable, or something like that, So be smart about it. Don't create multiple accounts when one will do. Be prepared to support each accrual. No cookie jars or rainy day reserves. And so what I mean by that is, let's say you're having a bad month and you're like, what? I know I'm going to have, XYZ expenses next month. I'm going to just accrue for them this month and get the expense in this month. And then I'll pay the bill next month out of the accrual on your balance sheet, your accrued expense liability, and not incur an expense in that next month when I actually used that service or got that, product. Don't do that. That's called fraud. That is financial statement fraud. Don't do that. I mean, fraud's a big word for this. That if it's like if you do it constantly, then someone's gonna be like, okay, you're a dishonest person. But lots of people do this like a little bit. They have like, oh, this like accrued expense account that's just there in case they miss something. Don't do that. If you either incurred something or you didn't. Keep a list of stuff, be able to support it. It just looks sloppy, frankly, if you have stuff in there that is just there because you're worried about missing something. Be consistent. Always be consistent. All right, revenue. Have separate accounts for each type of revenue stream, product, or service, like I showed you in that example chart of accounts. Write down your process for recording revenue. How do you know when it's earned? So if you deliver a service and it takes a long time to deliver your service, a common revenue recognition practice is called percent complete, which basically means you estimate how many hours it's going to take for you to do this job, and you record revenue in proportion to how much of the hours have actually happened. So let's say your job's going to take 100 hours and you've put in 50 hours of work, and you estimate that you're on track to meet that 100 hours. So that means you're 50% done. So that means you should record 50% of the revenue. And if you haven't billed for it yet, you would actually put unbilled revenue. So you'd have unbilled revenue somewhere, but you should just bill for it. It makes it much easier, much simpler if you should be billing in advance. Don't perform work that's not billed. So have a payment schedule that either aligns directly with when you're going to do the work or slightly precedes it. So you have accounts receivable, and then it makes it a lot easier to do this. But either way, have a process for recording revenue, know what it is, and have it written down so you can explain that. This is so critical because any buyer needs to know how you're recording revenue. They need to know when you record it and, all the different types of streams and how they differ. This is how much revenue you're doing, obviously, is one of the key inputs to valuing a business. So a lot of your forecasts, for instance, start with revenue. You start with revenue and then you work your way down and you use percentages of revenue to compute some of the other line items on your income statement. So getting revenue right is absolutely critical, and being able to explain differences period over period, also very, very important. Make sure you have terms for your customers on invoices. So this goes along with how you record revenue. So if you have a product and you ship this to a customer, most of the time legal title transfers at the time that you hand over the package to the shipper. So the customer actually takes legal possession at the time that you ship the product to them, which means you can record revenue when you ship it. I've also seen, for instance, when it passes the ship's rail, so if you have a product that's being shipped overseas, maybe you have an office in the United States, you're producing in, Vietnam or China or something like that, and you're just shipping from there direct to your customer. Lots of companies are set up like this. They might own a factory in China or something like that, and then, ship the finished goods directly to a customer from there. So in that case, they might, as soon as the good, passes the ship's rail, is put on the ship, that's when title passes. Sometimes it's just when the good gets put on a loading dock, to be shipped. But that should be written on the invoice like the shipping document that goes to the customer, that should be right on there so it's clear, who owns what. If you perform a service and use percent complete, like I talked about earlier, maintain consistent documentation. So have a standard template for computing this and use it every month. So if someone wants to look at multiple months, they all look the same. The methodology is consistent and it's easy to recompute how you got to your final answer. Unearned revenue, I talked about this a little bit earlier. If you use percent complete, you're going to have unearned revenue. You're going to bill, you should bill as, early and often. Get that cash, and, for anything that you've billed, so you would have, when you bill it, your accounting system is going to do debit accounts receivable, it's going to book an accounts receivable, and it's going to credit revenue, increase revenue. Then you're going to do your percent complete calculation, and you're going to adjust revenue from there, likely downwards, to make sure you get your revenue in the right period. Anything in excess of any amounts that you've billed in excess of what you've earned gets recorded as a liability, as either deferred revenue or unearned revenue. I know I'm getting into the slightly more complex accounting. Understanding this is really important, though. Being able to explain when you record revenue, understanding it so that you can do your own analysis and really figure out where your business is going is absolutely critical. And like I said, this is a huge focus for buyers. This drives trend analysis. If you have revenue recorded in the wrong period, they can't do anything. They can't do a good analysis. And that is going to be frustrating and could ultimately end to a deal failure. Okay, so moving away from some of the financial statement line item specifics, let's talk policies and procedures. Boring. No one wants to talk about this. I'm not talking about writing reams and reams of documentation. You don't have to have all these binders explaining exactly what you're doing. I'm just talking about making it easy for a potential buyer to take over. The more things you have written down, the more routines that you have and structure in place for your employees, the easier it is for someone else to take over and be successful. Do not keep it all in your head. This is very typical for small business owners. They have all this stuff that only they know how to do, or at least they think they're the only ones who know how to do it. And they just do all this random stuff every month, and they keep it all in their head, and that's how they're organized, and they think they're great and wicked smart, but really that's not smart. You should write it down and delegate it if you can, but anything can be written down. Almost anything can be broken down into a set of simple tasks and steps that can then be delegated to somebody else. So don't keep it all in your head. Write it down. Encourage your employees to do the same, especially your bookkeeper. Everything starts with the accounting records. I get it's not necessarily critical to delivering your product or service and getting your accounting records right. But if you want to sell your business at some point and, be able to grow and know which direction you're going in, getting your accounting records right and consistent and having it just be simple is a huge deal. So again, write down everything, have processes and procedures, have ways of doing, and not just in accounting, but in other areas of your business too, like your, marketing efforts. What's your process for determining what best, marketing campaign to do? How are you measuring the success of that? So these are really important. And also, if you are delivering a service, and safety is important. If you're doing something that is dangerous or, moderately dangerous, You should have safety protocols, things like that. Pretty basic stuff. Okay, FP&A, financial planning and analysis. This is the bread and butter of the due diligence process. You, as the owner, should know more than any potential buyer coming in. They might know more about the industry because they might have experience running similar companies to yours, but you know your company the best. So you might have an edge over some of your competitors that leads to a better growth rate, for your revenue, or you might have more profitability. You might be doing more with less. You might have really great employees that are just super efficient. So be ready to talk growth rates, customer concentration, vendor concentration, expense management. All of this obviously starts with clean books because you need good information to do a good analysis. So let's talk about these. Revenue growth. There's historical and there's projected. Any good analysis starts with what have you done? What does your business have a history of doing? So you'd look at historical growth rates for the past, 3, 4, 5 years, whatever makes sense for you. And then you'd say, okay, this is where I see the market going. You might look at analyst reports or something like that, whatever industry journals you can find to see, okay, like, is this a growing industry? Is it matured? Is it declining? Am I selling like a Kodak camera when digital cameras just came out, like that kind of thing. So you'd use that historical analysis and those, that industry information to figure out what you think your future growth rate is going to be. This is what a buyer is going to do. This is how they're going to value your business. One way of valuing your business. You also want to think about customer concentration. If you have few customers that account for a huge amount of your business. So for example, if you sell a product to Walmart and they're like 90% of your business, that's a huge risk for any potential buyer, because if Walmart stops selling your product, you're going to go out of business probably. Same deal with vendor concentration. If you have someone who's producing your product or a third-party contractor who's helping you deliver your service, and they are responsible for a huge portion, and without them, you would fail, that's a huge risk factor for your business. On the other hand, if you have a whole list of people that you could switch to, if, that current vendor goes out of business, that's a contingency plan, always very important. That is a lot less risk for a potential buyer. So something to think about. Expense management goes without saying, managing your costs, being on top of things, being able to explain why you incurred certain costs in one period versus another, and also just always looking for the lowest cost, or rather not always looking for the lowest cost provider, but when it makes sense, finding the lowest cost provider. So if you like the service, if you're paying a premium because you believe in the service and it's adding value to your business, do it. But always be thinking of ways to reduce certain costs, especially recurring costs. So health insurance for employees is always like one of the hot topics because it's expensive. But if you provide good benefits for your employees, you may be able to attract better employees, more experienced employees that make it easier for you to deliver your service, or maybe you can charge more for your service as a result of that because your people are so good. So like I said, this all starts with clean books. You cannot do this analysis if the information that you're looking at is wrong. Or even if you just don't feel confident in it, you're not going to be confident in your conclusion from the analysis either. All right, have a financial outlook for your company. So if a buyer comes in, you got to be ready to argue with them. Be ready to support your position. Know where you're going. Have a plan. Forecast. So start with a simple forecast. And, you don't have to do all this at once. You start with simple things, so a very simple forecast. Just start looking out 6 to 12 months. I have a tool if you need one. If you check out my website, ledgerready.work, sign up with your email, and I will email you this simple forecasting tool that I put together. It makes it very, very simple. You can do it in probably under an hour, put this thing together. And just start reviewing that forecast against your actual results each month. And I guarantee you, just from looking at it and spending a little bit of time with it, you will get better. You'll get really, really good at it. And you'll start noticing things. Oh, hey, when it's warmer outside, or like something like that. Like if weather's a factor, for your business, like you might start seeing those types of trends. Whereas when you weren't looking at your numbers, you weren't noticing that, So like, or a better example would be tariffs, the government tariffs. Oh, when the tariffs kicked in, my, revenue went up, but my costs also went way up, because you had to charge more money or, whatever. And my margins went down. Like, and you might have been thinking, oh, I charge more money to my customers, and maybe you weren't focused on your costs, so things like that. When you're dealing with a potential buyer, be prepared to defend your growth rate and profitability assumptions with hard data. So having clean books and records and looking at it regularly, you're going to be really good at this. You're going to know. You're not just going to have a good idea. You're going to know. You're going to, okay, this is how much I'm going to grow by, unless something completely unexpected happens. And this is what my profitability is. It just is, so like this is what I'm going to make. Especially if you have just full-time employees, you know what you're going to pay them, so you can get really, really good at this. Even large, huge companies with very complex businesses are really, really close on their budgets to what their actual results are. This goes without saying, but know your expenses inside and out. Any potential buyer and an auditor, if you have to have your financial statements audited through this process, they're going to ask you all kinds of stuff. Why did this increase? Why did this decrease? Does this expense correlate with some other part of your business? Like, for instance, why did your payroll taxes go up? Obviously, they're either going to go up because the government changed the rate or you have more employees, so like something like that. Did you start working with a new vendor that's more expensive than the last one? Did you hire more employees, like I just said? Give your employees a raise. Or were you otherwise required to comply with a federal law resulting in more compensation expense or some other expense? Maybe you had to incur legal fees for something, maybe you applied for a trademark and you incurred some fees for that, so a bunch of stuff like this, especially the one-time expenses, just know what they are and be ready to explain them when someone asks. Know your margins. Know your margins. So critical. Know how much money you're going to make based on your revenue. And be able to talk about how they've changed over time. How are you managing it? Which direction is it going? Are your profit margins shrinking or are they growing? I've had situations where I've been working with people and I've shown them their historical financials month over month and had someone say, no, that's not right. So they'll think, oh, my profit margin's 33%, and then I go, well, I just looked at the last 3 years of your business and you've never once achieved a margin of 33%. And I have literally had someone say to me, oh, my accounting records must be wrong. Because, and they weren't. The accounting records were right. They just weren't reviewing them enough to know, one, that they were correct. They didn't rely on them. But also, they didn't even know their own margin because they weren't looking at the numbers. They were just looking at what they were selling these jobs at. So it was slippage. They had some slippage on jobs. They had some unexpected costs come up. Their estimates for their costs weren't right. So the margins were lower than what they were expecting. But if you review your numbers, then you'll know. So it's not rocket science. Just be focused on it. All right. Buyers, these are some other things that buyers are going to be focused on. What kind of capital requirements does your business have? Does it require additional cash investment to grow? If you have goals for profitability, or revenue, do you need more cash investment to achieve them? And if so, how much? And also, along the same line of thinking, what is the return on that investment? So if you want to grow to some number and you have to invest a certain amount of cash to achieve that, what is the return? So how much more profit are you going to make as a result of that investment, and over what period of time? So that tells you what your return on investment is. If you're going to borrow the money to do that, then that's very important to know what your return is, because you want to make sure your return is greater than the interest that you're paying on the loan. So all of this stuff, very important, and obviously starts again with accurate accounting records, because you cannot do this analysis with bad information. All right, this is how you start. I've said a lot, so you're probably wondering, geez, Sean, what are you doing to me here? You're telling me to do all these things, and I got, I just have to run my business, and then I got to go home and I got to play with, I want to play with my kids, and I make dinner and I don't have time in the day for all this stuff. Okay, I get it. I really do. So it is a lot. But if you don't start somewhere, you'll never get it all done. And if you really do want to sell your business, all of these things are very important. So here's what I have to say to you. Start small. Review your chart of accounts. Just start there. And set a goal. Just say, okay, you know what? I have 10 minutes I can set aside each day to do this, which is fine. So just block it off on your calendar, or set a recurring meeting with your bookkeeper or something like that. Maybe it's every month. So just block off an hour or two once a month to sit with your bookkeeper and go through this stuff. If you think your chart of accounts is a mess, start there. Do that first. Don't start meeting with your bookkeeper yet. Get your chart of accounts figured out first. Okay? So just say, are these in the simplest form? Start with cash and just work your way down, and just spend a few minutes working on it every day or every week. Okay? Once you get your chart of accounts done, then you can start having regular meetings with your bookkeeper to go over the results of that month. Okay? So you're just looking for stuff that doesn't make sense, vendors, customers you don't recognize, fluctuations in expenses that look odd, or an expense that should be recurring that isn't even showing up. So evidence that something didn't get recorded. So things like that. You will get better naturally just from doing this. So just start. You might be terrible at it when you first start doing it, but just keep doing it. Just keep meeting, keep talking to your bookkeeper. Hey, what did you see? What's going on? Then you start, as I said, layering in comparisons to the previous month. Okay? Once you start getting better at this, then you can put together a forecast. Once you're comfortable with your historical results and that everything's recorded right, and you have a good process, put together a simple budget or forecast. And like I said, I have a tool. Check it out at ledgerready.work. There's no need to build your own. I've already done it for you. So check it out and just add the budget or forecast review to your monthly meeting. Just have it be another check. You're comparing to the prior month and you're comparing to your budget. Okay. And then you just look at the stuff that looks odd or not as you expected it to be. If your budget's wrong and it's just not happening the way you expected, update your budget. Keep updating it. It's not a set it and forget it thing. Like, sometimes you see companies only do it once a year. That's silly. Update your budget as you go. Always have it be always have the future months be your most accurate guess, of where you think you'll be. Okay? Periodically review industry reports and use that information to improve your budget or forecast. Because there's a lot that you can control, with growing. You could be, spending more money marketing to grow your top line, something like that. But there may be things out of your control, like a global recession, for example. In 2008, a lot of home builders went bankrupt, or had huge declines in revenue that was completely out of their control. The housing market fell through, and nobody had any equity in their homes to use to get a loan from a bank to do work on their house. So those types of things, those types of events, hopefully not so significant, sometimes show up in industry reports. It might help you get more accurate with your forecasting. All right, so that's what clean accounting records means when people say that. And the goal is to simply have a ironclad understanding of your financials and your business and be able to explain it to somebody else. And no, when I say it like that, it sounds simple, right? But any potential buyer, they want to feel warm and comfortable. They want you to wrap them in like a Snuggie blanket and be like, everything's going to be okay. Like, here's my numbers are right. This business is headed in a good direction and it's ready for sale. They want to be set up for success. So start small, set aside some time. I know how busy everyone is these days. Set aside some time, not a lot, once a month or a few times a week, whatever makes sense for you, and have a timeline for how you want to achieve each of these goals. How quickly do you want to clean up your financial statements? Is it important to you that you get it done in the next month? Or is it okay if it just happens over the next year so that by the time you get to the next tax cycle, you're ready? Something like that. And by the way, all of this work that you're doing to clean up your financial records is going to make tax season like no big deal for you. No big deal at all. You would just, once it's all cleaned up and organized, it's as simple as exporting a few reports and sending it to your accountant. And they might ask for some additional expense detail or something like that. But if you've already cleaned all this stuff up and you already know where everything is, it literally is like a 5 to 10 minute task. Maybe an hour. I don't know if it would even take that long. But if you could get your taxes done in January, and maybe if you owe a bunch of money, and you want to, okay, I can pay this now, and maybe you can pay a small amount later. The thing is, you can't owe the IRS too much money, or they will charge you interest and fees. You're gonna have to pay them anyway. So why not just be done with it? You can delay the filing of your tax return till later in the year, but you can't delay paying them, unless it's just a really small amount. So having this stuff cleaned up just gets these things off your plate. It's okay, taxes are filed, they're done. Now I can move on, that kind of thing. So I hope this was helpful to you. I've said this a few times throughout, but again, I have a forecasting tool that I've put together that you can download when you sign up to my email newsletter at ledgerready.work. You will get an automatic email to where you can download. I saved it in a Google Doc folder, It's just an Excel spreadsheet, but it's very easy to use. It tells you step by step exactly how to build your financial forecast, and the output is automatic. It goes 12 months out, or if you want those months to be years, then go for it. But that should make it very easy for you. All right. In the meantime, if you like this, hit subscribe and like. If there are topics I talked about today or didn't that you would like me to get into in more detail or like me to touch upon, just mention it in the comment section. I'm happy to do it. All right. Thanks for watching. I'll see you next time.